Evening, everyone who's joined so far. We'll just give it a couple of minutes, sort of just on 7. So, just wait a little minute. We'll see who else joins, and we'll get cracking in a couple of minutes. So, firstly, who's Sprout? We were founded in 2016 by Troy Constant. So, Troy is our CEO. He's down in Yass. We're a fully integrated professional services firm with a focus on agribusiness. We were formed to support farmers and the agricultural sector to increase its wealth and profitability by merging various areas of financial management into one holistic and independent service. So really the key there being independent. We obviously do a lot of work with banks for those of you who have worked with us in the past, but the key word being there independent. So we're not aligned to one lender in particular when we are doing finance and bank work. So we're really just a third party that can provide, very transparent advice and a transparent service. Our fundamental goal, is to help businesses grow, and particularly those in Australian ag. So what we do, we have 3 core services. By far and away, our largest service is our ag finance part of our business. So we help a lot of farmers with acquisitions, so property purchases, refinancing. A lot of that comes down to finding a more appealing interest rate. A lot of the time, interest rate actually doesn't play a big part in that, and it's more about service. So, as I'm sure many of you have had plenty of interactions with bankers in the past, having a good banker can often outweigh a better rate. So, we're really involved in that whole finance process. So from start through to settlement, and then post settlement, we sort of see ourselves as an advisor moving forward and a quasi sort of relationship manager, because we often see that just the nature of agribusiness banking these days, you might not have that manager for a long period of time, whereas the model that Sprout has been built on, we've just got a lot longer tenure in our employees. So just a bit of a point of difference there. And we've obviously got a business advisory arm, so that's really around cash flow planning, strategic planning, setting goals, and debt advisory services. And then thirdly, succession planning. So I won't go too much into that tonight, but because I'm sure you've a lot of us here have heard that word in the last few years. But yeah, that's just one of the other arms of our business that we play in. So we're really located from the Queensland border down to the Victorian border. We've got our offices ranging from Gundy through to sort of central and southern New South Wales, and we really sort of focus on being regionally based. So since inception, we've helped 2,000 farming clients. We've established 8 offices. We're roughly doing between $500 and $800 million in lending per annum. So that can be refinancing, property purchases, equipment finance, livestock finance, all that stuff I mentioned before. We've helped facilitate 50 succession plans to date, and we have a team of over 30 people, and that number is forecasted to grow pretty significantly in the next sort of 5 to 10 years. So watch this space. So getting into it, just touching on starting with scale. So what I'll be discussing tonight on the scale side of things is firstly why scale matters. We'll then have a quick look at a break-even analysis and just getting our heads around that, and then discussing economies of scale. So firstly, what is scale? So scale isn't just about getting bigger, it's about lowering costs of production, improving return on assets, and in an industry where so much is out of our control, scale provides us with options. So firstly, we've got scale lowers cost per unit. So markets pay us the same price per kilo, per tonne, no matter how big you are. That's one of the things that's completely out of our control. Profitability from scale comes from lowering costs by diluting our fixed or our overhead expenses over a greater production base. So in other words, scale improves margins without relying on better prices. And I'll give us a case study on that shortly, so it's a bit more of a practical view on what I mean there. Secondly, scale improves resilience in tough seasons. So larger operations absorb poor years better because overheads don't crush cash flow as quickly. It gives us more flexibility to destock, adjust, lease, delay selling, and it just gives us options and a time to make decisions. Third, scale improves our labour efficiency. So, as I'm sure many of you on here tonight know, labour is one of the biggest challenges in running an agribusiness or a successful one. Larger systems have better processes, better infrastructure, better role specialisation in our labour units, and all of this results in improved output per labour unit, and it continues to grow materially with scale. So that's point 3.4. Scale creates options. So with scale, life becomes easier. It's easier to bring the next generation in. It's easier to fund succession. It's easier to fund mum and dad into retirement, absorb our siblings, invest in genetics, water, tech, infrastructure. Smaller, financially tight farms really struggle to do all of this because their margins are tighter and profitability is restricted over a smaller level of production and a smaller asset base. And fifth, and this is not an exhaustive list by any chance, but we just see these as the main things when we're talking with clients. So number 5 is standing still is effectively going backwards. So without fail, input costs are going to rise almost every year. Compliance and complexity increases. Without scale or efficiency, our margins compress gradually, stress increases, and our options narrow. So just a quick break-even analysis, and I'm sure many of you have seen one of these before. It's not rocket science here, but yeah, it's just a quick break-even chart that I'm sure many people have seen, especially if you've done an RCS or a Farm Owners Academy course. This is probably something they would have touched on. So as you can see, our fixed costs sit there regardless of how much we produce, and that's never going to be a perfectly straight line, but you can see that it doesn't move, whereas variable costs increase relative to what we produce. When we talk about overhead or fixed costs, what do we mean? We mean expenses that need to be paid regardless of production or scale, production scale. So we've got labour, things like rates, insurances, motor vehicles, repairs and maintenance to a degree, accounting fees, a portion of fuel, and obviously all of these things will increase, relative to scale. But what I'm trying to get across here, and you will see shortly, is that we're spreading this out over greater production and a greater asset base. And then when we're talking about variable and direct costs, we talk for a cropping operation, we've got things like seed, fertilizer and chemical, harvest costs, freight, and then for a livestock system, we've got things like animal health, vet and AI, supplementary feed, fodder, commissions, freight, and of course in a trading system, we've got cattle purchases. So just a quick case study of what I mean by economies of scale. So we've got 2 scenarios here. One on the left-hand side, we've got before scale. So it's a 1,500 hectare cropping operation. We're producing 3.5 tonnes to the hectare. Total production is 5,250 tonnes. So what you'll see on the after scale side of things, where we've doubled our cropped area, our yields haven't changed and our price per tonne hasn't changed either, but we've doubled our production, so therefore our income has doubled with that. You'll see our variable expenses. If you just look down on the third row from the bottom, we've got our variable costs at $650 a hectare. Some of you might disagree with that, but just for the sake of the exercise, that's what we've used. And then so that works out to be $975,000. And for our after scale, that's $1,950,000, which is simply doubling it because we've doubled our production. Where the magic happens is with the our fixed expenses, our overhead costs. So we've got $500,000 in our before scale scenario. In our after scale scenario, we've doubled production. Our variable expenses have doubled, but what we've done is spread our fixed overhead costs over a larger production or asset base. So yes, it's increased slightly. That might be due to an extra labour unit, a bit of contracting, rates, just a few things that are inevitable with expansion. But relative to where we were before, we've spread that 500,000, turned it into 600,000, but it's reduced relative to what we're producing. So our total expenses obviously have gone up, but where it really shows is our operating profit or loss. So we've got an operating profit of 360,000 in our before scale event. After scaling, we've now got an operating profit of over $1.1 million. So working that out, and that's, as I said, the magic really comes from spreading those overheads out. We've now got a $133 a hectare improvement, which, as you can see, simply flows through to the margin, to profit. So then we've just run a little sensitivity analysis. So again, before and after scale, we've got 1,500 hectares and 3,000 hectares of cropping. Yields haven't changed, but what has changed in the yellow here is our price per tonne. So what that's done is it still costs us the same to produce all of this, but we've turned that profit, that $360,000 profit, into a nearly a $60,000 loss. And if you look over on the right-hand side there, our profit has fallen from over $1 million, but we're still on a profit, is the point I'm trying to prove. And we still have that $133 a hectare improvement versus before scale. So looking at that from a break-even scenario, where before scale, our break-even point was $281. If we're only receiving $207 a tonne, we're running at a loss. After scale, our break-even point is now $243. We're receiving $270. Our margins has reduced, but we're still running at a profit. And looking at that at the price received per tonne before scale, or profit per tonne rather, we're $242 a hectare and $375 to $350 a tonne. When we're receiving less for our grain, that profit quickly turns into a loss, but we're still running at a profit in that after scale event. We've just run a quick one as well for a livestock enterprise. So you can see here we've got a before and after scale event as well. Before scaling, we've got 1,000 heads. So currently we've got 1,000 head breeding operation. We're turning off 850 calves annually, retaining 200. So we're selling everything that's left over. We've got a few cull cows that we're selling there as well. So we're receiving 1,500 a head for our weaners and 1,400 for our cows. It's total livestock income of a bit over 1.1 million. Our overheads, again, 450,000. So they're our fixed expenses that we were talking about before, and our variable expenses at around 270,000. So just looking down to the bottom there, our variable costs, we're working off $350 a head, and that doesn't change in either side, either before or after scale. But what we've done is we've spread our overheads over a greater production. So we're now receiving an extra $162 a head, or we can look at it as you're saving $162 a head. And again, that comes from spreading these overheads. So our overheads have gone from 450 to 520. Yes, that's increased marginally again to allow for additional rate expenses, maybe a bit more labour, whatever it might be, a bit of R&M. But yes, you can see our profit is nearly doubled for only having to increase to by 60%. Another little sensitivity analysis. So we've reduced what the price per head we're receiving for our weaners and our cull cows. You can see the market's tanked. We're getting $850 for weaners, $1,000 for culls. Our total livestock income is $672,000. Doesn't even cover our costs. We're now running at a slight loss. Over here, we've been able to spread those overheads over a larger production and asset base. Yes, our income has reduced substantially from $870,000 to $124,000. Looking at the two after scale scenarios, however, we're still running at a profit, which in an industry where cash flow is so cyclical and sporadic, profit is everything. So looking at that, our break-even here, so our break-even price is $934 before scale. When the price falls, we're only receiving $873 a head. Break-even afterwards, after scale, is $772 a head. We're receiving more than that due to our being able to spread those overheads, and we're receiving $873. From a profit point of view, so before scale, we're still getting that $420 a head profit and $549 at normal prices. Prices fall, we're running at a loss. Prices fall after scale, we've still got that little bit of margin there to play with. So when things do dry up, the market dries up, we know we're going to be right. Just moving on to the use of debt as a tool to scale. So I'm just going to quickly touch on quickly where the finance market is, what rates are doing, and what the big banks are thinking what's going to happen. And I think it's quite interesting because that's changed very quickly from Monday to today. If Joe didn't point out that there are a few updates, I'd be giving you very false information, which we'll touch on in a second. But and then we'll be talking about debt in Australian ag and unlocking equity to scale. So where we're at the moment, this is as at today. So the RBA cash rate's held at 3.6%. The 90-day BBSW, which stands for Bank Bill Swap Rate, it's at 3.76. So a lot of you with debt here tonight will have a product that's based off a BBSW rate. So this will make up a large portion of what the interest bill that you pay, and this will fluctuate. You can see it's higher than the cash rate, and that's because markets expect rates to go up, not down. Aussie dollar about 66, 67 cents. Looking at what the next 18 months look like, really the only two. So this graph was almost the opposite about 3 or 4 days ago. This morning I updated them. The only banks now that are forecasting rates to stay flat or not move are Westpac and ANZ. CBA and NAB forecasting hikes through to March 2027. And you can see that lighter blue line there. The markets are pricing in an upwards movement in rates. So no reprieve at this stage, and unless we see some different data come out of inflation and unemployment. Sure, I'll leave that one up to Michelle Bullock. Just touching on where we're at in Australian ag and debt across the country. So this is including forestry and fishing, not just broadacre and dairy agriculture. So from 2019, we've virtually doubled. So this graph is looking at August 2019 through to November 2024. I don't want to bore you with graphs tonight, but I find this is really interesting and it tells a lot. So we've started at $75 billion in debt across Australian ag in 2019. Fast forward to November last year, that number's just about doubled. We're at $130 billion. And there's been a few things that we attribute to that. Firstly, that a lot of this period we had record low interest rates and we had banks that were trying to get money out the door, and agriculture was a big sector that they were trying to sell money to. So that was one of the biggest things. Secondly, we've seen a lot of increase in farm size and intensity of production. Changes in commodities produced, so a lot of people diversifying and moving from a straight cropping enterprise into a mixed enterprise, and whether that be through renovation of their own land or purchasing different purchasing places that run different enterprises. It's been a fair mix from just from a Sprout perspective. And thirdly, we've got reduced farm cash flows because of drought conditions. So coming out of 2019, there was a lot of people obviously strapped for cash. So we've seen a lot of working capital increases to get themselves out of that and to start being productive again into those wetter years post the teens. And the last thing that we've seen contribute to this is provision of exceptional circumstances in interest rate subsidies to farmers in drought. So what do we mean by that? We mean RAA and Regional Investment Corporation, or RIC loans, especially earlier in sort of the early 2020s. These were at a big discount, especially when rates shot up around 2022. Those products were trading or provided at a heavily discounted rate, which we see these days those rates have actually converged, and a RIC loan is not far off what you'd be paying with a bank these days. And I'm sure a few of you have had a bit of an experience with the RIC previously, and they can be great, but they can make things hard to get done, especially when we are talking about scale and expansion. It's just another layer that we have to get through. So just where we're at in terms of equity. So I'm sure those of you who have a bank manager, you would have heard this term thrown around a lot. So since 2000 to 2024, we've seen debt increase marginally. So that dark green line there, we've increased from, call it 500,000 to about 1.5 or 1 million in debt, versus the average equity being over $12 million or 91%. So What does that actually mean? It means our assets, relative to our liabilities, are extremely high. And what that tells me is that we have a lot of lazy balance sheets or a lot of untapped equity sitting there, and predominantly that being because of our massive increases in rural land, particularly over that 2020 to 2023 period. As you can see, that's sort of when these lines have shot up. So yeah, what that means is there's a lot of opportunity to use the equity to scale in our businesses, and whether that be through expansion or diversification, we'll get to that. So scaling through expansion in our own business. So this is just a case in our own enterprise or industry. This is a quick case study of a client who, say, has a $12 million asset basically in land alone. They've got $2 million in debt, so their net worth is around $10 million. This is excluding all other assets and that they might have, like livestock and machinery. So a quick equity calculation, which is our net worth divided by our rural assets. We've got an 83% equity position with a loan to value ratio of 17%, which is 2 million divided by 12 million. So we've got our current position there. The neighbouring properties come up for sale for $6 million. We're going to fully debt fund that. That'll be provided by the banks. We've got an interest rate of, call it 6% as a long-term average, a loan term of 25 years. And we've got an interest-only period there at the start of the loan term for 3 years to allow things to get up and running. We'll assume a capital land growth rate of 6% over this 25-year period, which is what we'll be assessing this case study on. So our proposed position, we've now got $18 million in our land assets, $8 million in debt, which is our $6 million plus our existing $2 million, and our net worth is still at $10 million because we've fully debt funded that purchase. So our equities are reduced to 56%, which is getting down there, but it's still in a manageable position, especially from a debt point of view. And our loan to value ratio is now 44%, which is highlighting that we're utilising our equity a bit more productively than letting it just sit there on our balance sheet. Fast forward to this. So this is 25 years later. What have we created? So without the purchase, with our land appreciating at 6%, which you can see that number's not too shabby. It's not bad at all. So our land has increased to a bit over 51 million, 51.5 million. Less the land asset values at start, so just our starting position of 12 million, less the interest that we've paid over that 25 years, assuming we're paying off the debt completely by the end of the 25 years, we've got a net wealth increase of 37 million. Assuming we've gone ahead with the purchase of at the neighbouring property, our land asset values at the end are $77 million. We've assumed we're not taking any more debt on at this time, and everything's worked well for 25 years straight. Our land asset value being 18 million, less our interest payments of close to $8 million. So we've paid off our debt entirely. We've paid the bank $7 million or close to $8 million, but in turn we've created an extra $13 million in wealth for us. And what we were talking about before, and that creating options for scale, for succession, that just really, I think that's a number that highlights the point we're trying to prove. And Joe's going to touch a bit more on the use of debt in ag and diversification now. I'll let him take over. But if anyone's got any questions, feel free to chuck them into the chat and we'll get into it afterwards. Thank you.
No worries. Thanks, Oscar. And good evening all. So I'm just going to carry on a little bit about what Oscar was discussing here, and obviously using debt as a tool. Just going to focus a bit on what banks look at when acquiring finance for growth. And I guess a few different tools you can use to scale your business. So firstly, just to explain what banks are looking at when you're trying to acquire capital, the three main themes that they would look at starting here is obviously the 3 C's. So firstly, there's character. So this is basically whether the bank trusts the business. And they get this from things such as, your previous borrowing history, education, ability to meet your previous goals, and, whether you can demonstrate a strong business plan, I guess. And then capacity. So this is basically your ability to service and repay the debt, and stuff like strong financial history, providing a cash flow to support the additional lending, and just being able to show how that debt can be repaid from the business is sort of what they're looking at from there. And then finally, from a collateral point of view, this is really the security that you can offer the bank, whether it be land, livestock, equipment, whatever the security position is. But it's basically what the bank can take a charge over for their security if you're unable to meet the commitments that you're entering into. So these three pillars, I guess, are the main foundation for any sort of lending decision. And certainly if you can demonstrate strength in all these, then you position your business pretty well to be able to access capital freely. So Oscar's touched on a few of these metrics already, but I guess just to make sure everyone's sort of aware of them, but basically, these three here are the metrics that lenders typically rely on to ensure that additional borrowing is within their appetite. And these three are probably the main ones for, I guess, agribusiness lending that we're looking at. So your equity position firstly. So obviously, as Oscar touched on before, that's just simply your assets via your minus your liabilities. And this includes all your liabilities and assets. So basically your entire balance sheet. And basically a strong equity position obviously gives the lender confidence that they can support you during, fluctuating business cycles, whether that be from, seasonality or market variability, basically. From a security point of view, the main one there is obviously your loan to valuation ratio, which Oscar's also alluded to, but basically it's calculated as the loan amount divided by the security value. And I guess a key difference here is the difference between that and equity position is it only refers to the debt and the security that the bank has a charge on, not your entire balance sheet. So there was stuff that falls outside that. So it's just key to, I guess, notice the difference between the two of them and how banks sort of use it differently. And then finally, serviceability, which has become, quite an important thing. The days of sort of just lending on equity are behind us. But yeah, basically, serviceability is generally measured by interest cover ratio. This is simply your EBITDA or your earnings before interest, tax, depreciation divided by your interest expense. So this basically shows your capacity to service the interest. And then also another metric to that is your years to repay, which is obviously calculated from your cash surplus after all your costs that Oscar's mentioned, your interest. It's basically showing the time taken to repay your debts. So yeah, it's important when using debt as a tool to scale that I guess you're aware of where your business is with these metrics. It just gives you the knowledge to know what your capacity to leverage is. And it gives you yourself better access to capital by knowing these things. So I just thought it'd be useful, I guess, to show what typical major banks want to see as guidelines for those metrics when looking at new funding requests. So typically for an equity position, most major banks will want to see a bare minimum equity of 40 to 65%. Your loan to valuation ratio, your LVR, typically the maximum is anywhere between 60 and 70, depending on the bank. And then your ICR, typically 1.5 times the interest that you need to pay. And then their serviceability terms on years to repay is anywhere from 15 to 30 years. And typically most major lenders will have an interest-only period maximum of 2 to 5 years, unless there's some good reasoning behind why they should be outside that. So as you can see from this, there's quite a range between the different metrics depending on the banks. And that's just because banks have, different policies, and it's quite variable where their appetite and policy sits depending on, their own risk profile and their lending limits at the time. So but generally, as an overall, banks are willing to support growth if you can meet these thresholds. But it is worth noting that they're obviously not set in stone, and banks certainly will look outside of these metrics. But I guess, you just need to have a business plan that shows some strong reasoning as to why, and I guess how over time your business position can sort of return to within the bank's appetite. So obviously sometimes there'll be proposals that, clients want to do that don't fit within main banks' appetite. But I guess if you have the confidence in what you're trying to do and you think it's a sound opportunity, there is alternative avenues, I guess, to access capital. I guess the positives of looking at alternatives, include sometimes you can, get faster approvals and funding. and a lot of the time there's greater flexibility in deal and security structure. So they'll take on more risk, etc., which we'll touch on shortly. And I guess some of the limitations there is some of these alternatives come at a lot higher cost to your main bank lending, and some have stricter exit requirements. So I guess it's just important to define, I guess, a clear purpose for the funding, and make sure it fits within the business's direction. Some alternatives, I guess, for standard loan facilities, or term debt as we would call it, would be sort of second and third tier lenders, I guess. So your second tier lenders, these generally include your non-major banks, so stuff outside your big four and stuff like that, and some non-bank lenders. So a lot of these lenders will still have relatively competitive rates, sometimes matching, the major banks, even better at times, but up to, a couple % higher than some of those major banks. And I guess the flexibility that those guys have is there's a little bit more flexibility around their policies than some of the main banks, and they just may have a bit more appetite to riskier proposals. And I guess some examples of that would be sort of a business with some poorer financial history, or a business that's sort of looking to expand quicker than the other banks sort of prefer. Stepping down, I guess, from that again, you've got third tier lenders. So these will generally be non-bank or private lending groups. So these options, generally suit a pretty high to medium risk profile, as their policies are much more flexible than both those other two options, I guess. So I guess, touching on that, the main thing is you must be cautious with these, I guess, things, purely because the cost of these is typically 10% and above, and a lot have strict exit strategies. So, these options can be good, I guess, for bridging finance or urgent opportunities with short terms. But it's important, I guess, to have a clear exit strategy if you are going to look at sort of expanding through that option. Outside, I guess, the term debt lending facilities, there's probably a couple others that we see. These are probably the three main alternatives: equipment, livestock, and trade and working capital. So equipment finance is, structured repayments, aligned with the asset life. Obviously, you're taking security over the machinery or a piece of equipment or an asset. And I guess the benefit of that is that it can free up some capital in the business, which can then be, invested elsewhere. Livestock finance, we see a bit, the positives of livestock finance, pretty quick approvals, generally, flexible terms. You don't need a lot of information to get them done. And one of the big draw cards is a lot of those facilities can be fully secured against the livestock, which a lot of term debt can't be. So it sort of leverages a different asset and frees up your property. And it sort of has flexible repayment options to sort of align with your cash flow and the schedule of those livestock. And then finally, trade and working capital. It's suited to trading operations. There's many different products within that sort of realm, with a variety of securities and how they sort of operate, but they can be utilised, and facilities like that can sort of improve your liquidity and cash flow within the business, which can then be reinvested elsewhere. So it's freeing up that capital within your business. So I think, look, these options here are great options for accelerating growth. I guess they don't tie up your property as security. They can also, I guess, improve cash flow, which can then be invested elsewhere. And I think another big thing is it enables timely opportunities. So, securing a trade opportunity as they present, we obviously know that the window for that is small. So I guess, time to market is an important thing that these products can sort of, act on. This is just a case study of using, I guess, one of those alternative finances. So this is a client that we've worked on. The client's a cattle operation who was looking to buy a neighbouring property, but their current property assets were already pretty leveraged. So as you can see, their current debt structure there is, made up of term debt, and there's also a working capital facility, and then there's obviously the EF. But the main point here is that both that term debt and the working capital are secured against the property, and that working capital is mainly used for cattle trading. So I guess the highlight here is the top graph here is I guess a graph of the overall funding table of what it would look like without sort of restructuring those facilities. So if you put the property purchase of $2.2 million in there, as you can see, the equity drops down. Obviously, our assets and liabilities have moved. But a big thing here is obviously our LVR has increased to 72%. So our solution to this is by, I guess, restructuring that working capital facility, the $1 million that we spoke about previously, which was used for cattle trading, refinancing or restructuring that to a specific trade facility, which relies on the livestock for security rather than the rural property, freed up the capacity in that property to leverage against that, and then helps secure the funding to purchase that property. So as you can see from this bottom section graph here, the overall equity position hasn't changed. The assets and liabilities are exactly the same, but our LVR here is now at 61%, which is well within the bank's appetite. And that's given them the opportunity that the bank now has the security that they can fund that. And I guess that just shows the importance of correct structuring around debt, particularly when you're trying to scale these things in your business. A little bit of a different one, I guess. Another tool that we see more and more commonly now is, scaling your business through off-farm investments. As Oscar sort of mentioned before, given the strong equity that a lot of farming businesses have now, they're in a pretty unique opportunity to sort of leverage that and create some scale outside their current businesses, and that's something that may not be open to other businesses outside of ag. So I guess, looking at off-farm investments, this sort of helps diversify the business. It can create some passive income. And, as Oscar said before, sort of assisting with succession planning, having multiple off-farm assets to provide options, around retirement, siblings that aren't returning to the farm, it creates that option. So the three main asset classes we sort of see in off-farm investments, firstly, residential. It's a familiar asset class to all of us. We all know housing, but it sort of requires lower equity requirements to get into it. It's considered pretty low volatility compared to some others. I guess the shortfall for some residential property is, the majority of the time these investments are negatively geared, which can mean drawing cash from the farming operation, which, as Oscar alluded to before, may already have cash constraints, as a lot of them do, as those costs have risen, right? So another one we see is shares or equities. So these investments have very low entry costs. They're very liquid, so you can get in, get out very quickly. But they generally come with higher volatility compared to some of the others, and there's some large downside risk if you try and leverage that sort of asset class. And commercial property. So these assets typically have a higher capital or equity requirement to enter, and more complex borrowing structures, but generally have a higher net yield and are typically cash flow positive, which sort of adds some passive income back into the overall business. And that's probably an asset class that we've seen more and more of throughout the business, and it's purely because, as Oscar said, I think farmers are very well positioned that that higher equity requirement to get into it, they're pretty well positioned to sort of take advantage of that. So just really briefly, but borrowing for off-farm investments is a little bit different to agri-finance options. Some of the metrics are a bit different, how they service and stuff, but at a very high level, resi typically lend up to 80%, so you require 20% of capital or equity to put towards the investment. Noting rural property cannot be used as security to support this, so that's just an important thing to note that some people sort of get mixed up on sometimes. And these are typically financed over a maximum sort of penite term of 30 years. Commercial investments typically financed, up to 70% LVR, similar to your rural property, depending on the bank, and generally will have a loan term of 15 to 20 years thereabouts. And then just on equities, we mentioned before, you don't see it as much, but equities can be financed using margin lending. It's generally secured against your share portfolio or cash. The amount you can borrow is typically based on the value of your portfolio, but it's just careful to note that if the value of your portfolio falls and the LVR exceeds their maximum requirements, it can be issued with a margin call, which would force you to liquidate some of those shares to bring you back within margin. So, I guess the downside risk of leveraging those can be quite high. This is just another case study, which is sort of touching on that off-farm investment. So this case study is an example from a client who was looking at building some off-farm assets purely to give them options in the future with succession planning. These guys were sort of 10 to 15 years looking to retire. And basically, we look to leverage the equity in their rural property to build scale in their off-farm assets, basically. So the client decided to leverage their assets to purchase a $2.5 million commercial property. A few things to note: the property had a net yield of 7%. And notes with a lot of those commercial contracts, they'll have annual rent increases contracted into the agreement, and a lot of these all outgoings are paid by the tenant, so no cost to them by their borrowing costs. And the purchase for this required the client to provide $750K deposit, which they sort of utilised a combination of equity and cash to facilitate that. But it could be all equity also. But as you can see, this is sort of just a breakdown of, I guess, the investment. As you can see, the purchase from the beginning was cash flow positive. Year one, a surplus of $49,000. And then basically the surplus funds were put straight back into principal reductions for the life of the investment. So as you can see, the net yield increases each year as it's contracted in their agreement, and over time this asset slowly reduces the debt that was first used, obviously, to purchase it. I think the real benefit for something like this comes, towards the end of it, and you can see here by year 15, this loan has been fully repaid purely from the investment itself, and what the client's left with at the end of that is, an asset that's got passive income close to $250,000 by year 15, and an asset that's worth $4.5 million by year 15 and 5.5 by year 20. So, this is all created from their initial investment of sort of $750K. And, I think, as I said before, an option like this really, it helps diversify their assets. It hasn't drawn any cash from the business, which I think is a big one. That's no matter what, it's standing on its own 2 feet and supporting itself. And the big one is that it's created options for future growth, like $250K of passive income. It can fund retirement. They've also got an asset there, whether it's to give to off-farm siblings or children. So yeah, it's really created options within the business, I think. So yeah, that's a bit about it. So I guess in summary, look, I guess what we speak to a lot of clients about is, debt is a strategic tool that can allow growth and scale. And I think it's just important to, keep those key lending metrics in the back of your mind, to allow for scale while still managing, the risk of the business. I think, well-structured finance improves outcomes. So having the correct debt structure there, helps preserve capacity and improve cash flow and presents, more opportunities for growth. There's some alternative and asset-backed finance there that can be useful tools to unlock growth. It's just about knowing the risk of all those and, I guess, having clear purpose in why other alternatives are used. And then, I think, leveraging equity in your farm to diversify, and even, on farm, but, off-farm investments, can strengthen your cash flow, reduce risk, and I guess support, growth for generations. So that sort of wraps up, I guess, what we had from our point of view. As I said, if there's any questions, we'll sort of keep checking those throughout. But I guess a lot of what we've spoken about is sort of expanding your business and stuff like that. But I think one of the keys that you do have to focus on is making sure your business that you've got now is sound. And that's sort of why we've got Scott here. He's a master at, I guess, looking at that. So yeah, hoping we can, we'll pass on to Scott to, I guess, give a bit of background, and then sort of present on, working on within your business and the profitability of what you already have. So thanks, Scott.
Awesome. Thank you, gentlemen. Everyone can hear me all right? Awesome. We'll dive straight into it, just in the interest of time. Gentlemen, that was a fantastic presentation, and certainly for me, a lot of great takeaways. certainly make sure you ask some questions in the little Q&A box as we go, and please ask some questions through my presentation as well. Love to answer your questions as we go. Also, just wanted to congratulate you for taking time out of your business to start to work on it. There's plenty of excuses, particularly this time of year, to not get out, to not put yourself in rooms like this, and to continue to sharpen the sword right up through these busy seasons. So well done for that. Quick little intro to me. I grew up around Bingra in the Upper Horton, on a cattle place there, married a girl from Come By Chance out near Walgett. Sim and I live just outside of Toowoomba on a little cattle property now with our two girls, Arabella and Coco. My background, I've spent 25 years predominantly in corporate ag, 12 years with Elders International, feedlots, live exports, slaughter programs, backgrounding all aspects of livestock agency businesses. We've been up in Toowoomba for around 14 years now. Spent a wedge of that time working for Morton Co. As GM there, and one of the things through that time at Mort in particular was I started to learn about the power of strategic planning and building a machine, and some of the elements of that we're going to talk about tonight around profit and cash flow that were some of the core ingredients from taking that business from a business that used to do 250 million revenue out to one that did 750, and one that used to do $12 million profit to one that times four that out to about 48 million over a 7-year period. So Swiften is now in its 5th year. So who are we? We exist solely to help regional and agricultural based businesses to scale. So there's been a lot of talk tonight about scaling, and that is our primary job, is to help businesses scale. The people we work with, they're not defined by location. They're from Port Fairy in Western Victoria to central and northern Queensland. They're not defined by scale. They're from startup through to long established businesses. They're not defined by revenue or profit. Some of them are struggling to break even when we meet them. Some are up to tens of millions of dollars profit. The commonality between them is they're all incredible humans. They've all got growth aspirations. At the bottom end, they're trying to double. At the top end, they're trying to times 10 their businesses. They realize they need help, and they've got an incredible engine and desire to implement strategies to help grow their businesses and to change their lives. So that's a little background to us. Please, as I said, chuck some questions in the comment section as we go. And if you haven't already, grab a pen and paper. There's a rule of 7 when we run this exercise. This is one of the most high value exercises we do with clients, and you should leave this presentation with around 7 pages of notes. You are here, so I would love to see you go to work to really optimize the short bit of time that we have together. Also, feel free, I know the gentlemen are recording this, but feel free to take photos of the screen as we go as well. Totally agree with everything that Oscar and Joe have been talking about in terms of unlocking growth through debt. For us, there's a couple of things that we see our clients who are having a lot of success in this space. So number one is they've got a really clear plan around growth. They've got clear long-term, medium-term, and short-term plans. They understand that the banks are in the business of lending money, but they also understand that the banks are in the business of managing risk. And risk comes down to a couple of things. So for us, it is how do we reduce risk and increase confidence? It is around building a history of execution against a plan, and that sort of speaks to one of the 3 C's around character and confidence. The other bit is obviously around serviceability. So tonight I really want to talk around profit and cash flow. A lot of businesses we meet, when they're trying to get more profitable, all they're focusing on is how do we get expenses down, and there are 7 levers we're going to talk about and thousands of strategies that sit below that. So I really want to dive into that, but this should be a really practical exercise. So grab your pen and paper and let's dive into it. Okay, so I've been in corporate ag for 25 years and I've seen a heap of different businesses. We work with anything from builders and party hire through to accountants, all the way through to through to meat traders, feedlotters, livestock agents. And I still haven't found any more than 7 levers to pull to improve profit and cash flow in business. So we're going to go through each of these 7 in a little bit more detail tonight. And I'm also going to give you a bit of an example. And I'm also going to give you just a real life story of one of our clients who's implemented one strategy from that. If you do have a profit or a cash flow problem today, we do work on the 80-20 rule. So if you've got a profit or a cash flow problem, 80% of the time, we need to sell our way out of it, and we need to put more focus on that top line. 80% on revenue, 20% on expense management. So as I said, there's 7 levers, but under that there's thousands of strategies. So one of my checklist items for all of our clients is I want every one of our clients to have a list of at least 90 initiatives when we start working together, based off this exercise I'm about to run through with you. And then all I want to do is I just want to attack 3 of those initiatives and implement them every quarter. So let's start on building your lists. As I said, I'm going to run through just a practical sort of example as we go. So this is a standard sort of business, might be bigger than yours, might be smaller than yours, but the numbers are still relevant. So on the sales front, this business gets 4,000 inquiries, has a 25% strike rate in terms of converting those 4,000 potential inquiries. So they have 1,000 clients. They turn up twice a year. They spend $500. So they've got $1 million revenue. Their cost of goods sold is 50%. They've got 25% overhead, so they make an operating profit of 250 grand. They receive their money in 40 days. They've got their products on the shelf for 100 days, and they're paying out in 10 days. So they've got an operating cash flow of 161. So I'm just going to show you as we go the cumulative effect of just pulling these levers slightly as we go. So in isolation, none of them are going to make a big difference, but when you pull them cumulatively, which is well within your power, you'll see the cumulative effect of that. Okay, so we are going to start with our 5th one, which is faster collections of debtors, because this one sits down in our balance sheet. So 90% of business owners have a balance sheet. The accountant sends it through, but they don't really understand it. So that's why we're going to start here. So we want to get our money in quicker, right? So we want the average day's money is outstanding to go down. So really practically, some of the initiatives in there, potentially reducing your invoicing terms. We see a lot of clients that are a bit lazy, or they're not resourcing effectively their invoicing. So they're sitting on their invoicing, they're not getting it out the door in a quick manner. We see a lot of clients that have overdue accounts, or they have serial offenders who owe them money. And so we want to develop credit policies, stick to it, you'll get what you tolerate. You are well within your rights if you have a credit policy to charge interest. So these guys have been talking about different types of interest and interest rates. Ultimately, we want overdue interest for our business owners to be the most expensive form of finance that any of their clients have. So typically they're setting interest rates on overdue around 18%. There will be time to time, depending on your business and industry, where people want to prepay you or give you deposits. So you want to be able to negotiate that, and for your system to be able to handle it. So in our business, so let's assume this is a merchandise business in a country town. So all we've done is we've just reduced their receivable days. So they used to get their money in from their clients in 40 days. They're now getting in 30 days. So we haven't impacted profitability, but we've impacted our cash flow by 17% just by doing that one mechanism. Quick little story, livestock agency client of ours, they had a lot of clients who were utilizing their business as their financier because they didn't charge interest, because they had a good relationship with them, and subsequently they were drawing them out. What that was doing in that business was it was putting enormous cash flow issues and pressure in particular on the finance team. So as we said, every business should have a credit policy. So we put a credit policy in place. We assign limits and authorities. Any of those outstanding clients, we put payment plans in place, including milestones. So they might have had a period of grace where they weren't on 18% interest, or they might have had payment milestones to meet, and provided they met that, they didn't get 18% interest. But they also had the threat of a stick over them that if they missed that, that new 18% was going to come into place. So we put stop trades, cash on delivery terms on some of those serial offenders. And ultimately in that business, just by tightening up that one little element, we reduced their debtors by 295 grand in the first quarter. And so that's been massive, right? Because that just turns straight back into cash flow, back into the business that we can use to grow. And now they also have a new framework in place around not taking on any new debtors, which has been massive for that business. Let's talk about reducing stock on hand or reducing inventory. So ultimately we want inventory days going down, and inventory days is ultimately the amount of days your inventory is on the shelf if you're a retailer, in the paddock if you're a farmer, in the back of the ute if you're a tradie. So ultimately the question we want to ask is, how do we get that inventory converted into cash quicker? So if you're a merchandise business, can you have a better procurement process, or even if you've got a livestock business, making sure you've got a really good procurement process, just in time inventory. A massive one for our farming clients is aged and surplus assets. I don't think I've met a farmer yet that didn't have 100 grand's worth of equipment sitting out in the paddock that was surplus to their requirements. So what we want to do is we want to turn that back into cash that we can put to work. Can you sell or run more stock on consignment? So things like adjustment are examples of that. Or ultimately, if you're in a livestock style business, how can we increase weight gain again to get those inventory days down as well? So let's look back at our standard example here. So you'll see down that second bottom line, we've just reduced their inventory days in this business by 10 days. So product used to sit on the shelf for an average of 100 days. It's now down to 90. So our cash flow is now up 20%. Profit remains the same. Let's talk about a retail business. So one of our retail clients, merchandise businesses, they're running a $2.4 million inventory, and arguably could have run that business on around a $1.6 million inventory. They're having massive stock take variances, 40, 50 grand write-offs, and really low margins. One of the other things they had was they had about 100 grand of aged stock, so product that was sitting on that shelf that they hadn't sold any units of in the last 12 months. So what gets measured gets managed. So ultimately, we started measuring that, getting those reports in front of their merchandise team on a weekly basis. We develop proactive sales and marketing plans. We've just done sales training with their teams, which is just having an enormous benefit on that business. And we put procurement procedures and controls in place. So in that business, we're able to bring down that inventory from 2.4 down to 1.6 million, which gets all of that back into cash again. We've reduced that 100 grand of aged stock. We've turned that back into cash. And ultimately, that business is significantly more profitable. So let's look at slowing down payment to creditors. So average days to pay your suppliers. So obviously we want this to go up. So the easiest way to do this is to increase your payment terms with your suppliers. One of the most powerful things that our clients have in their toolkit to negotiate this is they all have a really clear growth plan. They might have a 7 to 10-year vision. They'll have a 3-year target, a 1-year plan. And so they will onboard, they will inspire their suppliers with their growth plan, and they will show a history of execution over time as well. And subsequently, that means that they'll be doing more business with their suppliers, whether it's their bank, whether it's their fuel supplier, or anyone else who are those major expenses in their business. 9 times out of 10, there will be some latitude for them to extend terms. A couple of other strategies: time purchases to be more effective. So if you've got end of month terms on your fuel and things like that, just time those purchases to be more effective. And you can negotiate inventory protection where potentially you can return unsold goods like chemical and the likes. So let's look at our last one here on the bottom line down in our balance sheet. So through some successful negotiations, we've been able to increase our payable days by 10. So we're now paying our money out in 20 days instead of 10. So again, profit hasn't changed, but cash flow's up 34%. A quick little case study here. So like most of our business owners, this is a couple, and the wife, who isn't a trained accountant but who does a wonderful job of the books, is doing all of the accounts payable and receivable. And in this instance, she's just paying the bills a little bit early. So on average, about 5 days early. Whenever she's in the office, she's paying whatever's on the desk, and she's actually using that as her cash flow buffer. So if cash flow gets tight, she knows that she's got 5 days of paid invoices. So what we started doing was we started just getting her to pay those bills on time. We got her a bit of accounts payable support in at $50 an hour to start to help that. And ultimately, in that small little livestock trading and feedlot business, the average daily expenses was 45 grand. So you times that by the 5 days that they were paying early. Ultimately, that's injected another 225K of cash back into that business. Subsequently, that is one of the levers that they've pulled. That has enabled them to go and buy a second site to optimize great trading conditions through this year, pay down an enormous amount of debt from huge profits. But that's one of the really cool initiatives that they used. Okay, let's come straight back up to the top line. So one of the major ones is, how do we get increased volumes? How can we sell increased volumes at the same price? So the calculation for this is, how do we get you more inquiry? How do we convert more of that inquiry? How do we get people coming in, buying more volume more frequently? And so when I think about inquiry, I think about your marketing strategy. How do we get more people coming through your front door or inquiring into your businesses? Strike rate is really around, and volume and frequency is arguably around sales. And so all of our clients have a really clear marketing strategy. They're really clear on who their ideal target client is. They're really clear on what their must-haves are, and they are working on becoming very, very good salespeople or professional problem solvers. They also know that sometimes it takes up to 5 calls to convert a new client, and a lot of people give up before the fifth touch point. They're also in touch with their database regularly. They're also looking at how they can increase the range of products or services they can sell. They're looking at their facilities, looking at whether there's anything surplus in there that they can lease. But a massive one, particularly in ag here, around increasing volumes is, can you increase the size or weight of your product to sell at the same price per kilo, so your dollars per kilo. So our quick little merchandise store here, we're now impacting the top line here in sales. So we've increased through great marketing. We've got an extra 10% inquiry. So there's now 4,400 people inquiring. Here on the second line, we've got a little bit better at converting them just through some sales training. So we've increased by 10%. So that still only takes their strike rate from 25% to 27.5%. So ultimately they go from 1,000 paying customers to 1,210. And we've taken them from buying twice a year to just turning up 2.2 times a year. So now we're starting to have an impact on profitability as well as cash flow. So you'll see there in the operating profit line, our profit's up 33% and our cash flow is now up 78%. Quick little case study on this. So we've got an agronomy business that also sells Chemfert and seed. The owner was not a salesperson. He's an introvert, but he knew he had to grow sales. So we went through that marketing process. He clarified his ideal target clients, their must-haves. He developed a sales process, a bit of a script or a system, and we set some targets and goals. So his target was to ring 120 new ideal target clients and 20 inactive clients every 90 days. And ultimately, we helped coach him through that. So after all these calls, we'd just test and measure, we'd adapt, we'd work out what was working, what wasn't working. And ultimately, just by doing that, with nothing but his time and his energy and his focus, he was able to add an extra 250K in revenue in the first quarter. The really cool thing with that, and we talk a lot with our clients around compounding. When you compound that out quarter after quarter, that actually ends up being an extra 2.5 million revenue because he gets to keep the revenue from quarter one and quarter two and quarter three into the following quarters. So that 2.5 million revenue at 15% margin, just by doing that, he's adding 375 grand a year net profit to his business. And the really interesting thing out of that was it was that rule of 5. So it took 5 touch points in a lot of instances before he converted that client into a paying new client. Okay, we're ripping through this. So increase the price of good or service. Can you increase the price of your goods or services? This is one thing that typically as coaches, we can pay for ourselves a whole year's worth of coaching fees on day one because a lot of people have limiting beliefs, they have mindset, they have status quos in their mind of what they can and can't charge for their goods or services or what the margins are for their industry. And so we want to really challenge you around, can you increase the price of your goods or services? Might only be 0.5%, might be 1% or 2 or 3, and we can test and measure that again to make sure we're not doing anything reckless. But 100% of the time, every business we've walked into, we've been able to increase the price of their goods or services without any negative impact to their clients. Can you negotiate better sales prices? So a lot of you operate in commodity markets and a lot of you will say, what's he talking about? We're price takers in my industry. And we really want to challenge that thinking. Our view is on any given day, if you're selling a black feeder steer today, I guarantee you there is a spread of at least 20 to 30 cents, depending on who you are, where you are, who you're dealing with, what your relationship is. And I guarantee you're probably not the one getting the top sell price. So even in commodity markets, there is the opportunity to negotiate better and to unlock premiums in addition to what you're potentially getting to today. So a couple of other strategies here. Are there higher value goods or services that you don't currently sell that you could add to your business? Are you charging effectively for handling and delivery? Big one for ag is if you sell something on a quality spec, can you increase the quality? So if you're selling cattle over the hooks, can you get more marbling, more Angus premium, or can you reduce discounts for teeth, dentition, bruising, or any of those styles of things? Is there a high-paying customer you can attract if you use agents or sell through wholesalers or retailers? Can you market direct? Is there anything that you currently have that you can value add like a byproduct. And as I said, one of the major mindset shifts with this works even in commodity markets. Works whether you're cropping, whether you're breeding, whether you're trading, whether you're in feedlots, it does work. Okay, let's come back now and have a look at the final aspect. So we've been able to increase the price in this business. So from average of $500 to spend to now $550. So again, our profit is now up 46% and our cash flow is almost doubled down here in the bottom right-hand corner. Quick little case study. So I said this stuff works even in commodity markets. So we've got a cattle breeding operation that we work with, had a really good relationships with his customers, but was really struggling to hit his profit targets. So we did a couple of really simple things. We provided some introductions to our network, negotiated agreement with a supply trading expert. And ultimately, all we've really done in that business is just get him the right advice. We've increased his transparency about where the market is. We've added some more competition into his sales process. And ultimately, that alone has taken him from struggling to probably break even to adding 1.2 million of profit in year one, which has helped him hit his 3-year profit targets. And he's now into year 2 of working with Swiften, and he's on track for an 8 million profit this year, which will mean that he'll hit his 10-year profit target this year, and he should be able to maintain that going forward. A couple of other real benefits from that, in addition to the profit, is he still has great relationships with his existing clients, even though that there's more competition in there. And he has more time and less stress as a business owner, which is a major outcome we're looking for. Final one, team, is I'm going to put these two together, is how do we reduce cost of goods sold or your overheads? So most businesses have an element of shrink or wastage in there that we can stamp out. A big one is, can you negotiate better input costs? Start with the highest first. So you're in a room here with the team from Sprout. So typically one of those biggest ones is your interest bill. So have a look at those. Basically, we just start with your P&L and we look at your chart of accounts and what are your biggest expenses, and we start there and work our way down. Can you negotiate rebates? So if you're a volume user, as you build scale, there's opportunity to get some rebate there. Can you buy direct instead of through a distributor? One of the major ones we see in most businesses is just, can your staff be more productive? Can we lower your cost of production with really efficient training, better systems, better processes, technology, goal setting? We use a lot of incentives, incentive schemes with our business owners to create win-wins for clients, for your staff, as well as for the business owners. One of the massive ones is for our business owners to delegate low-value tasks. So we talk about it in terms of a high-value task being something in the $400 an hour mark. So what are the things our business owners are doing that aren't in their zone of genius, they don't love, they're not good at it, and it's not a $400 an hour task, and who can we delegate that to? Can we increase your production efficiency? So it might be higher cost but higher return. Can you own more of your supply chain to capture additional margin, or reduce customer claims or returns? Let's have a quick look at our final look at our merchandise business here. So we've now been able to have a 10% improvement in our cost of goods through good negotiation. So we've taken it in the middle there from 50% down to 45% cost of goods sold. Our overheads, we've had a 10% improvement. So we've knocked 2.5% off that. But ultimately, the main takeaway I want you to take out of this slide is we have just pulled 7 little levers just slightly, all concurrently, and we have basically increased profit by 90%, and we have increased cash flow by 160%. every business we work with is a growth business, and subsequently they are all cash hungry. And so we talk to our business owners about building machine, and this is part of that machine. In addition to having a plan and systems and process and team and being healthy, happy, having great relationships, being really good marketers and sellers, part of this machine is having a machine that prints cash, and that will help you unlock growth significantly sooner. One last case study here. So we work with a small family feedlot. When we first met them, to their credit, they signed up for a coaching program. They were losing 100 grand a month. They've been stuck in succession for years and years. Had enormous trading losses. They had custom feeding clients in there that they really weren't enjoying. One of their major issues was they just didn't have the control around their mill batch and feed accuracy, which was just leading to higher cost of gains. So we put a couple of things in place. So one was we started to commence measurement, we set targets, and we started to performance manage those staff. So we just turned up every day with yesterday's report, and we kept doing that. And so there was an element of performance management, or the stick with that. But we also wanted, and that got us to probably around 75-80% compliance, but our target really was 95% compliance. So we needed a bit of carrot, and so we did that in the form of an incentive program. So we just put $50, $50 in an incentive program. So if they hit greater than 95% compliance to those daily mill batch and feed targets, $50 got put in the kitty, and there's only 2 in the team. So they had the opportunity every year between 2 of them to earn an extra $18,250. For them as a business owner, the benefit for them is in the hundreds of thousands. And so that's a win-win for them. So ultimately, by doing that, we've been able to get compliance up over 95%, feedlots full, customers happy, maximizing margin, teams happy. Those guys have now gone from losing 100 grand a month to making over 200 grand per month. As I said, because they have a plan as well, and because they have a history of execution, not only have they got their bank support to fund growth in their business, so they've recently done a massive expansion, but they've also managed to get $750,000 in a government grant, again, because confidence is up, risk is down, they have a plan, they have a history of execution, and they have serviceability that sits behind that. But last little bit on profit and cash flow from me. There's only 2 other strategies around improving profit and cash flow. One is if you know there are areas in your business that you are hemorrhaging cash, we need to stop those where we can. And the only other one is capital raising. So capital raising may not necessarily increase profitability, but it'll help your cash flow in the short term. Again, where we want you to be is to have a full list under every one of those 7 different levers, to have all those initiatives, potentials in your business, and depending on your industry and your business type, some of those will be skinnier than others, but ultimately you should end up with 90 initiatives when you do this exercise well, and when we coach people through it. And if all you do is every quarter you just pick 3 of the quickest, simplest, easiest, highest paying ones, you will always be impacting your bottom line, and then you get that compounding effect that just is profit on top of profit, on top of cash flow, on top of cash flow. And that is how our business owners that we work with unlock this J curve of scale, which enables them to build a machine and then scale really, really rapidly. So for every one of those 3 initiatives, every 90 days, they just build some specific, measurable, achievable, realistic, and timeframe goals around it. So, team, I hope that's been insightful and useful for you. As I said, that's one of the most high-value exercises we do with people. We've rushed through it a little bit tonight. But please, if you haven't fully done that, watch this exercise back. Just keep brainstorming those out. If you're driving along next week, put those ideas back into it and just keep it as a central point of reference. And every 90 days, just pick the top three. If any of this has resonated with you, please give us a little follow on socials. We're on LinkedIn, Insta, Facebook. We're everywhere. We've got a website there. And the gentlemen know here we do a complimentary deep dive where we really get to understand people's businesses, where they want to go, what their challenges are, and get the opportunity to do a complimentary coaching session. So if any of that's of any interest to anyone, please send us an email, give me a text, give me a call, or ask Oscar or Joe just to give you a bit of an introduction. But thank you very much for your time. Again, congratulations. Well done on being here and sharpening the sword so close to Christmas. I've really enjoyed being with you all. And if there's any questions, please put them in the chat.
Thanks, Scott. Yeah, I do encourage, but we're pretty light on the questions for the moment. But no, Scott, thanks very much for that. I think couple of things that resonate with me is that it's such little things that are quite easy to work on in your business can have such a massive effect. So as you said, I think shows the importance of just taking time away from the business and looking at those sort of little things that can make such a big difference. So no, thanks very much for that, Scott. I've got a quick one, I guess, to kick off. Obviously, a lot about what you spoke there sounds like it involves all your employees sort of working for the same sort of goal. And you spoke about obviously a cash incentive there. Is there sort of any other sort of strategies you've seen to sort of get those guys to sort of buy in as much as the owners of the business and stuff like that?
Yeah, it's incentive schemes are potentially one of the most confusing things for our business owners. They're an easy thing to overcomplicate. So there are similar to profit and cash flow. There's thousands of ways that you can incentivize your employees, from free tickets to the movies to a ham at Christmas to cash, right? And so what we see typically is a lot of business owners, they're just doing random type incentives, and they're not ticking the box of is this important to the staff? And ultimately, is it changing and encouraging the behavior that I want in the business? And is it creating a win-win? So we've got a really good process we run through for probably the most standard incentive, which is a profit share type system. So this may not suit everyone in your business, but if you've got people that really have the ability to impact your profitability, your managers, your supervisors, your leading hands, depending on your business, there's a really good little structure there that creates a win-win. The other quick little complication in there is people link they want to put KPIs and they want to put incentive programs together, and they are two separate things. So every business should have KPIs, and if you want an incentive program, you should have a couple of KPIs, and the most simple ones are profit, values alignment, and safety. It's really easy to end up with 10, 15 of them, which overcomplicates things.
Thanks, Scott. I've got just a quick one. I know we're sort of getting towards the end of our time, but just quickly, what's the most common issue that you see within businesses that is also the most easiest or the fastest to address? So it's probably a bit of a broad question, but yeah, is there anything that really stands out that in those initial meetings that is straight away it's something that is a common theme across all the businesses that you work with, but it's also the easiest thing that you can fix? Is there anything that stands out?
Oh, look, I mean, day one with us is always strategic planning. So it's always around clarity and alignment. So that's always a big thing right up front, is potentially there's a bit of misalignment amongst the key stakeholders in the business. So generally with 40 minutes of pre-work and a day locked in a room together, we can get out of there with 100% clarity, 100% alignment on a 10-year vision, a 3-year target, 1-year plan, and clear quarterly goals. The other thing we generally do up front is profit and cash flow, because we want to start to impact that straight off the bat. And that there is generally 30 grand sitting in every business that are what we call jam items. We can just walk into that business tomorrow and we can unlock somewhere between $30,000 and $100,000 overnight, just by doing that exercise we did and then incorporating those into our quarterly action plan.
That's good. And thanks, Scott. And I would encourage people just to I've sat down with Scott and a mutual client, and I've watched him at work, and those complimentary sessions, there's a lot that he unpacks and a lot of value he adds, even just even in a sort of a 90-minute or 2-hour session. So feel free to reach out to Scott or reach out to us, and we can organise a meeting.
Any other questions from the floor? We're pretty light on, but probably last minute dash. But I guess just firstly, thanks to Scott for joining us. Certainly your insights are very valuable. And I think there's something that surely everyone can take away from that to implement their business in the new year, to really drive the growth of their business. Thanks to everyone for sort of jumping on. I know it's late in the year. I know it's been a big year for everyone, so we appreciate you sort of jumping on. We'll circulate, Scott, our details if you ever need to get in touch. But hope you guys all have a great Christmas and break. Enjoy a bit of a break and look forward to chatting in the new year. So thanks, guys.
Thanks, Scott.
Well done, gentlemen. Well done, everyone.
Thanks.
Merry Christmas.